Get started. Aliona, you ready?
Yeah, I'm ready.
All right, let's get started then. Hello, everybody. I'm Keith Harrington, co-founder and COO here at Novel Capital. Thanks for joining the next installment in our founder webinar series, where we like to talk to CEOs of companies that are helping other companies, startup companies grow. Um, at Novel, we are a fintech platform. We provide non-dilutive debt capital to early stage companies. And I'm really excited today to have Aliana Misko with me from Fuel Finance. Aliana, you want to share a little bit about what you do?
Sure. Hi everyone. Happy to be here. Hi Keith. Happy to make this workshop. Just like waiting for all insights that we decided to discuss today. So I'm a CEO and founder of Fuel Finance. I have financial background. That's a surprise. But also I'm a founder. So connecting all dots together, CFO and entrepreneur. And at Fuel Finance, so what we do, we work with startups, we help them to automate their financial management planning and analysis. So we build that platform that helps to get all the insights and avoid many financial mistakes that should not have happened in startups. So happy to be here and talk about how to actually avoid all financial mistakes and how to get money and investments.
All right, so how to avoid financial mistakes, and we're also going to talk quite a bit about forecasting. We all know forecasting is pretty critical, not just to running your business, but also to making it possible for you as a CEO to actually raise capital. Cash management, managing investor expectations, and raising capital are huge problems that CEOs often have to try to figure out how to solve for the very first time. So we're going to jump into those topics and hopefully share some tips and tricks. For anybody who has a question, please feel free to drop it into the Q&A box at the bottom of your Zoom screen. We'll answer those questions as they come in. And please don't be shy. Ask questions. Aliota's very interesting. I'm just going to yammer on for the next half an hour. So definitely guide us if you have any questions. We're happy to take them. So with that, I think we can go ahead and get started. Why don't we talk first, Leona, about forecasting? So we know, I know from my perspective as a capital provider, you know from your perspective as a company that's helping startups actually do their forecasting. To talk about why, from your perspective, companies need to get good at forecasting and when they need to get good at forecasting.
Yeah, it's a good question. I think that forecasting, so usually I see that founders they start to think about forecasting when investors ask them about their financial model or financial plan, or when investors ask them, okay, how much money you want to raise? And everyone started to think, okay, I need some financial plan or financial model or whatever. But we have this phrase inside Fuel Finance, and we always tell this to all founders that first of all, you need to have this financial plan, not for investors, but just for yourself. Because I think that financial planning and forecasting is the best financial tool for founder, especially when you just start your business or you already have some traction and revenues. For example, even when you have already $1 million in annual revenue. So it's already a good point to have a clear understanding how your business works just with numbers. So it just like understanding your business models, but with all the details. So when you do forecasting, you understand, okay, what KPIs your team should have, what number of leads, what conversion rates, how much like new customers we should acquire. So what will be our marketing budget for that? So, or how many people we need to hire. And when you start like to play with all these numbers, you start to understand how all things connected. So for example, if we will do this hiring or we'll do another marketing expense, how it will impact our runway or how it will impact our profitability, if we will have enough money after that. So for what period we'll have this money. So it really helps to be like I think, in connection with your finance, and you have much more understanding, and you can make much faster decisions. And I think that like when is a good question, when to start your forecast and your financial plan. I think that it's a good exercise from day one when you start to have your expenses. But the key question, how detailed it should be. Because, for example, when you just start your business, it's a good exercise. Try to model like how much money you need, for example, to deliver the product, to create the product, or get new customers. For example, like this is first exercise, and this is something that should be done, I believe, by founders. It couldn't be delegated to someone, so because you will get very detailed huge financial model and you don't need it. So I remember such cases from my experience. But later, when you're already like after 1 million in dollars in annual recurring revenue, so you definitely need much more details in your financial model, and maybe you need help from some financial expert who can help you like to understand that and play with different scenarios and do like plan actual analysis.
So you said something that I think is really interesting. You're saying at the beginning, you as the founder should be doing the forecasting. I agree. You should always be doing forecasting, because then you know how to measure progress against whatever you think is going to be the reality of the future, right? But how do you learn the skill? How do people who are founders who maybe don't have a financial background figure out how to make those first forecasts, so that they can then hand it off to somebody else who maybe gets a little bit more granular and a little bit more scientific about it?
Yeah, I think that we have, so happy to share after, we have plenty videos and cheat sheets and templates
There you
of
go.
financial models that everyone can use for free. And it's not like a big science like how to do the things, but I think like very high level. So first of all, you need to start from revenue side, and this is the most complicated part. Because you need to understand, for example, there are like two different cases. If you already have some revenue and traction, and you already tested some ideas, hypotheses, and you already have some understanding how your numbers look like, and this is an easier case. Much more complicated case when you have zero traction in revenue and you don't understand anything what works for you, and you need to make some plan and revenue. So in the first scenario, when you have some traction, it depends how your business model works. So you can start your planning from number of leads, after that, like conversion rates. And after that, you already have some recurring revenue, new revenue, churn revenue, upsells, downsells. But if, for example, like you don't have any idea, it's good just to have some assumptions. Like even bad assumption is better than no assumption at all. So in that case, I think it's just like you play with numbers and you try to analyze competitors, try to find information from other startup founders, and definitely will not have some big numbers from the start. I think the key mistake when what I saw, and I even asked investors like why it happens, because all startups, they do the thing with exponential growth of the revenue somewhere in the future. We all see such graphs all the time, and I think that Carta did this research. Yeah, Carta published that only 1% of all startups actually achieved this numbers of exponential growth as they planned that. But I think the best case for people like who don't have, and for companies who don't have revenue, just try to make like three scenarios, like your best case scenario, your pessimistic scenario, and some middle one, just to play and understand what you will do in different cases and in different scenarios. So what will be your actions around your expenses? Maybe you will hire like slower or faster. So maybe you'll have more or less expenses. It's not about have very detailed and accurate financial prediction. It's mostly about like way of thinking and being like prepared for anything.
Yeah, I think that's a really important insight when it comes to forecasting, especially at the very early stages of a business, is you're going to be wrong. But this is a great way to get into the practice of actually thinking about what are the key drivers of the business. And as your forecasts come back, wrong or off, you'll start to learn what are the actual drivers, just like you're
Oh,
saying, or you'll start to learn you'll start to gain a much more precise understanding of how the drivers do actually work and how they contribute to growth. So I think that's a super insightful comment that it takes a long time to learn that, and it takes a long time to get forecasting right. I mean, it takes iterations and iterations. You work with a ton of companies. At what point do you see companies actually get to the point where their forecasting is, reasonably accurate, and that they can actually start to plan effectively?
I think that from my perspective, what I saw like from all these hundreds of companies, so I think that the most accurate stage when you already tested ideas and you had plenty of experiments with your marketing and with your sales. So actually, it can take like 1, 2 years. So sometimes it can take 6 months or 3 months for some companies to experiment with them. But I think that the key goal, like when you have already very predicted revenue, when you understand what key channels work for you, and after that, when you understand, okay, these 3 channels bring us the most leads, it works, so we will scale this channel. So in that case, when you can answer this question for yourself, definitely already financial forecast is much easier for you because you just scale these channels and you understand the budgets. But the first year when you just make all these experiments and hypotheses, so it depends on what marketing channels you use. But in our case, I think we spent like more than $500,000 just to experiment like with different cases for 12 months in our marketing. And it's not a lot, it's very small amount of money. But in B2B SaaS, it's not about, for example, ads or something like that. For B2C SaaS, they invest much more in all ads and digital marketing. So these experiments can be much higher with the cost. But I would say that for the first year, it's better like to have some budget that you're ready to experiment with in your marketing. So for example, you raise some amount of money and you're ready to spend this, like, I don't know, 20-30% of this amount, like just to understand what channels work for you. And when you already understand this channel, so it's really much easier, like, okay, what will be if we'll do this experiment and we will invest 2 times more in this, for example, marketing channel. So if would it bring us like 2 times more leads or opportunities or one customer? So this is like how you work with that. And if you see if it works, you invest more. So for me, it's like clear like how you do this plan after you already see these channels.
A couple of questions based on that. So, you said once a company raises money, maybe allocate a certain percentage of that cash to running some of these experiments and investing in the growth engine. Um, what would you recommend for companies that maybe they haven't raised capital or they're still thinking about raising capital? How do you think about allocating budget in that case? Because in that case, there may not be a war chest of cash just sitting there waiting to get spent.
Yeah, that's a good question. I recently found it was a research. I think some VC company made this research, something like that. What is percentage is usually spent on R&D, on sales and marketing, and on operational expenses. And it was a research that it's very interesting that on sales and marketing, you spend less until you cross $7 million in annual revenue. So, and you spend more in R&D, so mostly in development of the product, and you spend on R&D like 200% of your revenue before you cross this line with $7 million in annual revenue. After that, you start to switch, so you spend less in R&D and sales and marketing is going up. So this is like a percentage that I saw, but it depends what business you build, because definitely we talk here like when when your expenses increase 2 times, your revenue is 3 times. So you're building not profitable companies, so and not bootstrapping companies. So you burn money, but definitely burn it like to grow very, very fast. But another case when you're profitable, so I saw some criteria to spend like 20-30%, for example, on sales and marketing from your revenue. So this depends on business model. And when we talk about ads, sorry, not about ads, but B2C SaaS products, I saw that they can spend up to 40, 50% of their revenue on marketing because they do digital marketing and because they have this paid ads before they will build organic growth. So it very depends on this percentage, but yeah, there's some numbers that I saw.
Okay, great. Thank you. So let's talk a little bit about how you help companies at Fuel Finance. So you've seen hundreds of companies in various stages of growth. Um, what are the companies that you are best at helping, and then what are you doing for them exactly?
Yeah, so I think we are the best for companies who are building SaaS, so SaaS business models. And what we do, how we help these companies. So first of all, we help them to set up financial system from scratch. And usually we work with, I think, the most complicated cases. So when you just have your QuickBooks, you have cash basis accounting, you don't have accrual based accounting, you don't have KPIs, you don't have financial plans. And here we come like setting up the system, setting up full clear picture what is going on in your company. So what is your month-over-month revenue growth? What is your churn rate? What is your retention? What is your cost of acquisition? So what is your budget that you can spend, for example, to acquire one customer, one lead? What is your maximum amount of money that you can spend? We also show different financial planning, different scenarios. So we help to have this financial models, financial plans, everything in one place. And this is, I think, when you go like to a serious financial system when you need it. So in most of the cases we see actually when you already cross this like $1-2 million in annual revenue, this is a period of time when you already want to have some system. Usually founders describe this as like, I need to have some KPIs and I can't have good sleep at night because I'm always worrying about like our profitability, our runway, what is going on. I can't understand. So I want to have some snapshot and clear picture. So yeah, this is, I think, the case where we come and we help with all of the things. And we onboard our customers, we explain how all the things works, and we help them to achieve their financial targets, not just like, like see and that's all, see the system and that's all. No, we help them to actually understand how they can improve their financial metrics.
So most of the companies that you work with, Aliona, they don't have KPIs set up and they're not really tracking metrics just yet. So they're relatively young companies. Is that fair?
Yeah, but we also have, I think, another type of companies where like we work with already CFOs, so, like much more sophisticated companies. So we have also companies who have some systems, some data, but they want the next level of data-driven decision, like to track everything, to have all the data in one place. And here we can work like with CFOs, with head of finance, so we can just help them automate and make faster strategic decisions. And these cases we also have. So I think like we are very broad, like with this like early cases and already more mature companies.
That's great. Looks like we've got a question from Karthik. How do you determine the right time to seek capital? And what are the key signals that show your company is ready for funding? Great question.
Key signals that your company is ready for funding. I can answer it even from our perspective because
Mhm.
I always do this for Fuel Finance to understand we are ready for funding. But I think there are, first of all, the criteria of revenue growth. So how fast you're growing months over months. And it like there are different types of funding. So we should understand that. So if we talk about VC investment, there is one way. When we talk about, I don't know, like another, so it can be like recurring revenue funding. So what Novel, for example, provides. So this is another way. So there are different criterias, but definitely when you see you're growing fast, you definitely see the traction that you understood what works for you in sales, marketing side, you want to scale these channels and you see that you acquire customers, they are happy, they stay with you, you have high retention. High retention, I mean, usually like it should be even negative retention. So you like not just churn customer, you like you have this upsells And this is something like when you see good traction month over month growth, and these numbers are changing now because I believe that previous rule of this unicorn rule, when you have this 3, 3, 3, and 2, 2, 2 growth like every year, so it doesn't work because now companies can grow like 10 times in 6 months. So this is changing very fast. And so for me, would be a good signal month-over-month revenue growth. I think at least 15%. It's like 15% month-over-month. It's good. Even if it's high, it's great. Like if you have 5, 10% for VC, I think it will be not very good case. And another part, if you have gross profit margin, so gross profit margin should be around like 70, 80%, even 90%, what is possible with AI part now. And definitely you should clearly explain like what works for you and what you want to achieve with your next funding. So what will be. But another scenario, I think that when you just have great business, maybe it doesn't like, scale with this crazy numbers months or months, but you definitely see that it works. And you understand that if you invest now more money in some channels in product, you will get higher results. So here where forecast is actually helps. So when you start to play with these numbers and just like ask yourself, okay, if I will boost this, for example, 2 times expenses in my sales or in my marketing, or invest more in my product and I will have high retention. So does it worth it? So if you answer yourself yes, after you do forecasts, you see this growth of your revenue, of your profitability. So it definitely worth to invest. And it definitely worth to evaluate all other scenarios, not just like VC funding, because VC funding is like not for everyone, I think.
Yeah, I completely agree, and I'll go just a little bit deeper on a couple of the concepts that you touched on. So, I think one of the first things that you have to think about when you're wondering, is it the right time for me to raise capital, is like, what would I do with it? If you know that it is something that you can invest in your machine and you put $1 in and you're going to get more than $1 out of value, then it might be a good time to raise capital. If you are at a moment where you just don't have enough cash to survive, that's not a very good time to raise capital. It's probably a better time to rethink the business model. And it's never good to be out trying to raise capital when your back's against a wall. But if you have the machine and
Yes.
you understand the metrics and you understand what you get from your machine when you invest $1, then it really becomes, how much value can I create for $1 invested? And then you can kind of work backwards from that and decide what's the right form of capital for me. So it's just like you said, VC is a great tool for very fast growing companies, but it can be very dangerous for companies that don't grow fast, because what might
Yes.
happen is they become reliant on venture capital funding. And when that venture capital funding dries up for them, which it will if they don't continue a very high growth trajectory, then those venture capitalists aren't going to write checks anymore, right? And if you've become reliant on being able to raise capital and you haven't been able to modify your business model to get to sustainability, that could be really dangerous. It can kill a company if you go too far. It can also be very
Yeah.
difficult to raise capital at too high a valuation, and then you're growing but not fast enough to catch up to that valuation, and then you can't raise capital at good terms, so you have to take a down round. That's no fun for anybody. Everybody gets diluted and nobody's happy. Sort of
Yes.
a It's not a company killer, but it can certainly be a morale killer. Um, and so
Yeah.
the way that we think about it is, if you're taking product and R&D risk, that's probably a good opportunity for you to get equity money and invest it in development. But if you understand your market and you have product market fit, and like I said, you know what happens, you know what you'll get if you put $1 into the machine, you know what you're going to get out of it, and it's more than $1. Um, that might be a great time to raise a different kind of funding. And what happens then is, you take $1, maybe you pay a lender like Novel, $1.20 or $1.25 or $1.17 for that dollar. But if you could turn it into $3 of value, then you could do that all day long, build value for your company. And all that value accrues to you as the CEO, you as the entrepreneur, and to your shareholders, and not just to VCs. So it's a it's a great question. It's a very layered question, and one where I think you sort of have to align. What am I trying to do? Let me make sure that that capital supports that, and then let me make sure that when I take that capital, I'm creating value in a way that makes sense. So that was a lot of words, Karthik. Hopefully that answered your question. Um, Anything more on that topic, Aliona, before I jump back into some questions?
Yeah, I think that's a good point that you mentioned about valuations, and that's something that I saw and our team saw for the last 1 2 years. So valuations dropped down. Many companies were not able to raise the next round, especially someone who switched like who already raised Series A and they need to raise Series B. So this is really was a complicated question, and I saw how many companies switched to be profitable. And this like new popular topic about being profitable is just like about this case that you mentioned that valuation dropped down and you can't raise next round, so you're not growing as fast as you need like to actually prove your next valuation. And yes, you need to be profitable and find another ways how you'll fund your company. So yeah, that's really important. I think this is something that you need to take into account when you think about different strategies and understand how valuation works. So for VCs and what multipliers they have.
So you see the same thing that we see. We see it from the
Yes.
perspective of a capital provider, where some of the companies that we work with who are venture backed, their venture backing sort of retreats, and their venture backers don't want to play anymore if they're not growing fast enough, and that's normal, and that's what happens. But I think in the last 24 months, it's been much more pronounced. Have you
Yeah.
seen the same thing with your customers where they've really had to make pretty tough decisions in order to stay
Yeah.
sustainable?
I think that we see two scenarios. So first one was about like tough decisions, cutting costs, being profitable, even like having, like good growth month for months, just because it was not enough. So early it was okay. Now it's not okay. It's still not enough. But I also see another trend that when I talk, especially like with B2B SaaS startups, many of them, if they're understood like what channels work for them, if they found their like product market fit, they can have good pricing. Now with what is going on with AI, they can automate bunch of their work. So they need to hire less people actually than they needed before. So I think just yesterday I talked with another founder who said me, yes, now we have one engineer instead of 10 engineers because like we use AI and one engineer now can do something that were done by 10 before. So it definitely changes the model because actually you raised with C money like mostly like for two things. You need to hire people to develop the product or you need to spend your marketing budgets just to get market share. So now I see this one with hiring people, so you definitely need less people that you needed before, and it also changing, I think, the whole strategy. And I'm just curious how VC will work in that case because I already saw companies who built like 5 million, $10 million ARR companies with just 2 3 employees, and it's like okay, and why they need to raise money in this case? So
Those employees are paid very well, I guess.
yeah. Revenue per employee is very good.
So let's jump back into forecasting and talk a little bit more about a couple of things. First of all, I think you said earlier, and I meant to highlight this, but you have a bunch of videos and a bunch of content on your website about how to really think about forecasting and financial planning and building that function for a startup. So I want to make sure we talk about that. Are there any particular resources that you would direct people to just get started?
Yeah, so first of all, we have on our website, we have a Bootstrap product. It's like free product, but there are 4 templates of financial models. So for SaaS business, for marketplace, for e-commerce, so you can find there the template that works for you. And there are also like video tutorials to these templates. So you can build this financial model, financial plan by yourself. So it's very easy. And we also added some dashboards there. So you can see not just numbers and reports, but you can see some graphs and see trends. So this is the first one. And we also have many cheat sheets. I think the last one actually that we launched was about different ways how you can get funding. So we actually did this different scenarios, so you can get funding in different scenarios from accelerators, from VC, being profitable, get loan, get money from companies like Novel. And we did like this as a mind map. So you just go and answer yes or no on different questions, and you choose like the final way of funding that will be the most applicable for you. So we'll be happy to share it after. You can just find it on fuelfinance.me and in our resources in cheat sheets.
That's great. Okay, good. Hopefully everybody will have a chance to check that out. I think those kinds of things are super important to share because it's no fun to try to invent all this stuff as you're going. Entrepreneurship, being a founder, is very hard, as you know.
Yeah.
Whatever resources you could use to accelerate your progress are definitely worth the research. So on forecasting. Uh, it's hard and it gets harder, but also easier as you go because once you've grown into a certain um, space or grown into a certain size, you can kind of start to see this is what we can expect. These are the numbers we can expect to see for the next year or so, given what we're spending and what we know about the business. How do you generally work with companies to actually produce forecasts? What data do you use? Does it change as they grow? Talk about how you actually do the forecasting and
Mhm.
predicting for CEOs.
Yeah, so I think when we talk about the next level, more complicated forecasting. So first of all, when we start work with our customers, we collect the data from all the sources, and I think the core data that is very impactful for forecasting. First of all, data in CRM systems. So for example, we have integration with HubSpot, Salesforce, whatever CRM system you use. And in your CRM, you already have data about number of leads, about conversion rates, number of days you need to convert customers from different channels. You already have information how many leads pipeline you generate from different channels. You have information about one customers, and you have all previous data. So the key secret, I think, about forecasting that early stage founders don't understand, that you should collect all possible data from day one. So like I think that many founders think, oh yeah, it's not important from day one. I have like so many challenges, marketing, like product building, whatever. And usually you just forget about collecting this data. But I remember that with one company, we had the case when they had all the data, and we just use this data to build different like demand supply like models to show them what will be the best pricing for them, with what pricing they will have the highest demand, the highest profit. And it was possible just because they had so much data for previous years, so we just like were able to run different scenarios. And this was very accurate. I think deviation was less than 5% of projection and actual result. And the same can be like when you collect the data, sales, marketing data from your like CRM system. If you have data for 1 year, like or 2 years, it's already like cool start point. When you can use it, you already have prediction with number of days. So you just predict not just like leads conversion rates, you already predict in what periods of time, in what months, because if your sales cycle like 60 days or 80 days, so it means that like leads that you get this month, you'll convert them in 2-3 months, and you need to have this information in your forecast, and you need like to have not just KPIs in your forecast, but also cash flow. So what will be with cash flow from your revenue? Because you can have customers, but they can pay in advance, or they can have post payments or whatever, or you can have problems with payments with customers. So they just don't pay. You have problems with accounts receivable. And you need to collect all of this data together to have very accurate cash flow prediction, especially when you're building profitable business. So cash flow is very important. So you can't be cash negative in some months because you just don't have like money to cover like this negative free cash flow. So this is an important part, I think, to understand. And when we work with customers, we just collect this data from QuickBooks, from billing system, from invoices, from Stripe, from HubSpot, for example, or Salesforce. So we even Google Ads. So we take the data about like if you, for example, collect leads and you convert leads from the website. So we take even this data to understand step by step what will happen with your business model. And after that, yeah, we definitely play with different expenses scenarios. And with expenses, usually your executive team should be involved because you have several plans. One plan when you go as you go, usually, so no changes. And this is like baseline scenario. But when, for example, someone want to plan new experiments or I don't know, new marketing budgets or new hiring someone want to plan or new softwares that you will use, so it should be included in the system. And in that case, all executive team members should be users of this financial plan. So they usually plan their budgets, they plan results from their budgets. So they have their KPIs, and this is already like the tool for all team members. So some data is inputted automatically and some data is actually added by executive team members or their teams, what they expect, what budget they will spend, what results they expect from these budgets.
Okay, that's great. Let's talk. I want to get to. We've got a question about another question about
Yeah.
capital raising. We'll jump into that in a second. But I want to ask, what are the biggest mistakes that you see founders and teams making related to forecasting? Things that they should keep in mind as they're going through their forecasting process or developing their forecasting process.
I think that the biggest mistake is I think expenses always predicted accurately, or they can be even higher. But I think mistake number one that usually founders and exec teams, they can predict very optimistic revenue growth. And I think this is the biggest mistake because when you predict very optimistic revenue growth, after that, you predict all other expenses. So you think, okay, we will be there, so we will spend much more. And when, for example, in the end of the first month, you're not there, but you already increased your expenses. So this is a problem that you have this gap and you are not already there where you want to be. And I think in this scenario, so this is what usually financial people done. So they're still very pessimistic and they try to challenge. Okay, what will be if we like have not so huge new revenue? So let's have it more pessimistic. Let's see like how it will go. And especially I think the best maybe tip here, just go to your previous planning for previous like 3 months and go through what was planned and what was actual result. So how you were accurate. If you do this mistake every month, so you plan 2 times higher than you actually do. So this is already a signal that you shouldn't do such plan for the next months. So your plan should be an average of the last like 3 months. This is something about like baseline, how you can stay more realistic. And this is something that usually we use. So we have this from financial side, we always have this baseline scenario and we just track it. And I think this plan actual analysis is very important to go through and analyze, okay, how we planned previous months. If it was accurate, what we learned from that, how not to repeat these mistakes for the next month. So I think this revenue prediction is like mistake number one. And I think with budget and with expenses, this is just about the culture. So everyone in the team should understand if they will spend more, how it will impact profitability or cash flow result. And if everyone connected to P&L and understand how they impact different lines on this P&L, from my perspective, what I see, it works much better. And you have like a team of people who are a little bit but CFOs, so they understand the things, and you don't need one person who will just like track what they do all the time.
That's great advice. I think it's kind of funny that you zeroed in on if you're continuing to miss your projections, then you should probably think about forecasting them differently. I really like the trailing 3 month average is sort of predictive of the future because it turns out it is. That's a really that's a really good way to do it. And as a capital provider, that's how we think about it. We look at rolling averages, right? You have to because we often will see forecasts that come in that are totally out of line with what the historical production of the business has been. And when we see that, we're kind of like, well, geez, do you really think you're going to do that? Because if you think you're going to do that, you're probably going to ramp up your spend. And if you're going to ramp up your spend, you're probably going to be too risky for us.
Yeah.
Because there's no evidence to show that you can hit your revenue projections. And I think that kind of leads us into another topic that we wanted to talk about, which is why does forecasting matter so much? I mean, it's obvious now, I think, why it matters so much to you as a CEO and as a business, as an entrepreneur. But why does it matter so much to capital providers? And I think that there are two answers to that, right? There are how equity investors think about forecasting, and then there's how providers like Novel think about forecasting. But and I'll jump into that, but I'd love to hear what has been your experience with the companies that you've been working with as they're out raising capital. What have you learned about how different capital providers are actually looking at and interpreting, and then making decisions based on the forecasts that they're being given?
Yeah, I think that there are, you mentioned, and I completely agree, there are two different perspectives how different capital providers actually look at forecasts. Because what I see, so investors and VCs, they're okay to see this exponential growth. And this is some, I don't know, what is that? Some secret for me on this market. So why everyone understand it doesn't work, but everyone agree with that. But I think that capital providers like Novel, so you definitely understand that you want to have realistic scenario, because it's about risk also for your company. So what will be, so you want to have this realistic way how company will grow. And I think a realistic way is also important, not just like for capital providers, but also for founders, because you need to be honest with yourself if you can pay this money back and what risk you actually have, because this is like percentage of revenue, percentage of profits that you give back. And I think that when I'm thinking all the time about, like, for example, different ways of capital that you get to your company, about like loans or anything like that, I think it's a very good way to actually build very good financial culture, because you have no way to make mistake, and you need to understand all the details in your finance. Because when you take this money that you need to pay back, you start to be very attentive to all the details. So there's no way, because in another way, I don't know, you will pay this money back like from your pocket. So it doesn't work another way. So I think in this case, it also a good boost, I think, to be very educated in finance in your company and very structural with that.
Yeah, I think that's true. Once you take on capital from an institutional provider, you do have to get very, very smart about the numbers. You have to get smart about the numbers before you get the capital, because you're going to have to be able to explain it to a capital
Yes.
provider who's going to have some questions. And to just go a little bit deeper, and Farah, I see your question, and I'm going to get to it. I'm going to touch on it a little bit here, but those two perspectives. An equity investor is going to look at your forecast, and they're probably not going to believe it. Let's just be honest. I used to be a VC, so I sort of know the drill here. And when I was a VC, I would look at your forecast and I'd be like, okay, maybe, right? But I would discount it. I would not assume that you're going to hit your wild, to the moon numbers. I would maybe discount it by a certain percentage, and then that's kind of how I would think about it. And then I would look at other scenarios too. But typically, your best case scenario that you share with a VC, they're not really going to believe it. And that's kind of I don't know, it's sort of a not great feature of the conversation, because you kind of know I'm telling you numbers you're not going to believe, and they're like, we don't believe your numbers. It's sort of an unspoken truth. So that's kind of an interesting dynamic. But what they are really looking for is really, really fast growth, right? Like you said earlier, Aliona, 15% month over month. If they don't believe that you can get there because the history doesn't say that you can, then you're not going to raise equity. That just is what it is,
Yes.
right? That's just the reality of it. And then there's another perspective on fundraising and providing capital, like what we have. So we're a lender. And if you show me wildly optimistic growth projections, it actually makes me a little bit nervous. It makes me nervous because I'm wondering if you have a good handle on your business, one, and two, are you going to like spend money to try to hit those wildly optimistic growth projections that based on your history, maybe you're not, I can tell that you're probably not going to hit. If that's the case, then I see risk in your decision making, and I see risk in the business that I'm probably not going to be comfortable with. So what we like at Novel is we just like a growing company. You don't have to be growing at 100% year over year, 200% year over year. You grow 10, 20% year over year. That's great. We love that. We love that all day long. So what we really like is to be able to look at your forecast and see how it lines up with how history has what your history has actually been. If your history is kind of like this, and then you have this after you raise money, that's probably not going to work out. But if your history is just kind of like this and you just keep going like that after you raise money and that's what your forecast says, that's going to be something that we can really believe. No matter who the capital. Oh, go ahead, Aliona, go.
Yeah, I have a question here. Sorry for interrupt. Just like curious, like you mentioned that it's important like to see like this growth, but what do you see like what annual revenue should be, for example, in the company to get funding from Novel?
Yeah.
And maybe you can share like what percentage usually like companies can get. So for example, like I don't know, we'll have $1 million in annual revenue.
Mhm.
So what percentage of funding, for example, this company can get like from Novel?
Yeah. So what we're looking for are B2B SaaS and tech-enabled services companies with at least $350,000 in revenue, all the way up to 20 million. So in your question, a company with $1 million in revenue, we can typically write a check or make a commitment of up to about 40% of a company's ARR or annual revenue. So in that case, if the company is growing and it looks like and it passes through our credit checks, credit model, then we could provide a $400,000 commitment. And then what we do is something that's a little bit unique in the market is we let you draw it down whenever you actually want it. So
Like
you could take
credit
a
line.
draw. Yeah. Well, kind of. It's a little bit different in that a credit line is going to be eventually due on the same day. What we do is
Yeah.
give you the option to, once you take a draw, you're going to pay that draw back over 2 years. So let's say you took a $500,000 draw or a $200,000 draw on day one. You'd pay that back over 2 years, and you'd pay a smaller amount in year one and a slightly larger amount in year two, because we just figure you can afford more payments next year. But then let's say you take the other $200,000 that we committed to you on day 365. You just kicked off another 2 full years of amortization. So that way you get to plan exactly when you want the capital. You get to sort of plan the cost, and you're only paying for what you want when you want it.
Yeah.
So that's how it works for us. And thank you for asking. I always like to do a Novel commercial.
Yeah, I always just like curious because I always evaluate for ourselves and also for our customers
Mhm.
different scenarios, like how they can get capital funding, and we always evaluate like different cases and what can happen in what cases they can get additional funding. So yeah,
Yep.
that's actually all questions that raised during forecasting, to be honest.
So let's jump into. I see a couple of questions here. Farah, you asked, one of the reasons why early stage founders go for equity diluting funding is because they might not have hard evidence to back up their projections. Are there other options available? As a seed stage founder, what metrics would I need to convince a company like Novel Capital, for example, that we're investment worthy? So my answer on that is what I just shared. For us, minimum of $350,000 in trailing 12 revenue. And once you're at that point, then we can start to see our way toward comfort with providing capital. One of the things about not having revenue yet, or not having very much revenue yet, is that's a very volatile place for a company to be. And that's where equity is really more appropriate, because most equity investors can tolerate a lot more risk than a lender, for example. That's why we look for a certain revenue amount before we can really provide a meaningful amount of capital. So hopefully, Farah, that answers your question. And then Emmanuel, how can a founder use forecasting to distinguish between strategic financial prudent cost management and detrimental cutbacks that could ultimately hinder the company's growth and sustainability? That is a great question, Aliona. That is all you.
Yeah, that's a good question actually. So I think that let me think about that. Uh, Actually, I think that between growth and sustainability. I think this challenge all the time for for the last few years from many startups, how to balance between that. I even was joking that there are just two topics on conferences, AI and how to be profitable. So like just two of them. And I think that I can give an example how we do that things at Fuel Finance. So we raised funds, but we always evaluate. So we take some projects, and for example, we want to spend some money on some projects. I don't know, in product development, in marketing, in sales, in whatever. And we make some exercise. So we start to evaluate this is a small project. So what assumptions we have about this project? What goals do we have for this project? How this goal will impact our some metrics on P&L or our valuation or our revenue or retention or churn rate or attracting new customers. And after that, we evaluate resources. So how much money we need to spend on this project. And we usually make the list of this project. So we can have like 20, 30 of them from different team members. And after that, we prioritize them. So very financial mindset. We prioritize that by return on investment. So what project has the highest return on investment? And when you compare just two numbers together, what will be the result from this project? What will be the goal? And what will be resources that you spend on that? When you just combine two numbers together, you understand where will be the highest return on investment. And this is like the mindset that you can use all the time. I talked with other founders and they were surprised, like, yeah, it's possible. We even like did some like valuation, some exercise how different projects actually impact our valuation. So it's not even revenue, but how they impact valuation. And I think it's a good exercise, and it also a good framework that you can give to your team to explain how you think about different projects and how you think about growth and, for example, being profitable. Because growth is important, but let's be honest, stupid growth is not okay. I mean, like stupid when you don't understand what you do, you just spend money and you expect that, okay, something will happen, maybe we'll grow or not. So this is not a very smart way, I think. So this is like framework that maybe will help you to balance between both things. And you all the time run through these different projects through different scenarios. So for example, if you're bootstrapping, you understand that maybe you can't spend like $20,000 or $30,000 on this project, but you can spend 10. So can you see withstand some signals that it works? If yes, start from that. Start from small amounts, start from, I don't know, small projects, small experiments, and scale them if they work. So that's what I see, how we think, like how to balance the things.
That's great. Thank you, Aliona. So we are at the end of our time. Aliona, any final words? We're going to put our contact information up so that everybody knows how to get in touch with us. Feel free to reach out to either of us directly. But Aliona, any final words before we sign off?
I think my final words will be like just don't be afraid of using different capital fundings, because I was surprised that some founders, they even don't evaluate different ways of funding. So they just know about one, getting money from VC. And I saw that many founders surprised that they can use like different ways. So you're unlimited in that. And I always say like my key phrase, and may the profit be with you during this journey. It will help in all cases.
Yeah, it turns out profitability matters. And
Yeah.
it's like you said, now it's all everybody talks about, which I love. I
Yes.
love to see profitable companies. So,
I also love
um,
it.
Aliona, thank you so much for joining us. Thank you to everyone who joined as well. Hope it was helpful, and hope you learned some tips and tricks. And have a great rest of the day.
Thank you. Thank you, Kit.